The management of Aarti Industries is ready. Suyog Kotecha, CEO and Executive Director with Aarti Industries. All right, Mr. Kotecha, Q3 was there in terms of the stress which was visible. How much of the stress was because of global factors, raw material, demand, and how much was there because of local factors?
Good morning. I think Q3 for us was, if you take sequential numbers, then actually we improved on our EBITDA almost 17% from 202 crore. We landed at 236 crores. So I would say Q3 was a quarter of recovery for us from the bottom that we saw in Q2. I think overall, in general, if you go across our end markets, most of the market remained quite steady from a demand point of view. Even agrochemical, where we have been seeing pressures now for quite a while, there we saw sort of inventory destocking story almost getting over in most of our end markets. And energy markets also stabilize. I think from pricing pressure point of view, yes, it does persist, especially from China, but I think we are getting used to it and building our strategies to tackle that as we serve the global market. So we look forward to continued recovery in Q4 as well, and expect a much better performance, especially when it comes to our polymer and energy markets in Q4.
All right. Good morning. This is Shrishti also joining in. But also we understand that the company has established the bulk shipping capabilities in Q3, which should lower the logistic cost. And so what will be the incremental benefit can we expect on your margins? And what is the outlook here on the margins overall? Are you still intact with your long-term guidance, or you want to make any changes there?
So the second part of your question, I think we are still maintaining our guidance, both short-term and mid-term guidance that we had given last quarter for this year as well as 3-year outlook. I think we remain confident of achieving both these guidance. I think the first part of that question on the bulk shipping capability is specifically for one of our product, which is a large volume product, MMA, which is getting consumed in energy segment. And given the kind of customer basket we have, I think we needed to build this capability on how do you ship sort of large volumes in, for a longer distance shipments, which requires very specific technical skills given the product quality requirements at destination ports. I think we built that. I think that's going to enable better volume placement in far off markets, and will also increase our capacity utilization for that product in the upcoming quarters.
When it comes to the pricing, then some of your the pricing of some of your key products have seemed to be stabilizing. But help us understand that where does the pressure still persist? Because there were also concerns about the rise in the competition as well. So how do you see the prices moving from here on, and which segments the pressure can still be on?
So broadly, we would say pricing pressure persists, but they have also stabilized at a particular level, right? So I think we have seen sort of downward trends across our products now for quite a few quarters. But if you look at last 2 quarter numbers, the prices have kind of stabilized. And going forward, we see that, especially in the two end markets of agro and polymer, where there is significant overcapacity in China, this pricing pressure may persist for a while, but unlikely to go below current levels, right? Versus the other markets where we have mostly domestic exposure, we are expecting a slight margin recovery as well.
But when it comes to some of the news flow related to tariffs on China, then we have seen that 10% of the tariff on China still persists, and the analysts feel that there could be some positive momentum or some order inflow where you can gain from as a company. So help us understand that where does the opportunity lies in industry as a whole? Where do you see this moving, and how the industry, the Indian chemical industry, can benefit from China plus one theme?
Well, looking at the news flow for last 48 hours, I think it's difficult to predict in terms of where the US policy is going to land. So I would say a bit premature to comment at this stage. In general, if the tariffs on China remain where they are today, then markets where we have exposure to US specifically, which is the agchem intermediates and polymer, should see good trend for us and broadly Indian chemical players, where at least the demand flows will shift to a certain extent. But as I said, we have to look at situation a bit more holistically. The Chinese capacity will figure out a way to place these volumes in markets outside of US, and in that context, we might have increased competition in some of the other markets, like of Europe and Japan. So the net impact, I think we'll have to continue to watch out for. Even the US tariff pattern itself, right? I think it's yet to stabilize. So we will wait and watch to see how it plays out.
Now, in the big picture, which is that just for the benefit of our viewers, since everybody wants to know what will move where, what was coming from Mexico, what will go from China, what will not go to China, what will come from India, can you just broadly tell us that in the export market, what is your presence? For you competing with manufacturers in Mexico, if 10% tariffs goes on China, how does life change for you? You can take all the time you want because we want a descriptive answer.
So look, roughly we are 50% exports, 50% domestic, right? Out of the 50% domestic that we have, even 20% out of that also gets exported out of country in terms of downstream products. So net we have a 70% exposure to global markets, if you put it that way. Out of which roughly 25% odd lands up in US, right? So that's the kind of exposure we are talking about. The two dominant end markets where we have a significant exposure are agrochemicals and polymer segments, where significant portion of our volume lands up in US, and we dominantly compete with China. I think Mexico and Canada are relatively, I would say, non-entities when it comes to specialty chemicals manufacturing. So bulk of our competition is with China, and that's where the impact on trade flow will be visible. As I said, so if the tariffs continue to remain where they are announced today, so for these two end segments, both us as well as our customers should see favorable tailwinds. But given the overcapacity that we have in China, the Chinese companies will figure out a way to place that volume somewhere else. Could be Europe, could be Japan, could be India for that matter. And hence, that's why I said the net impact is what we have to watch out for. The another aspect we have to watch out for is the relative currency depreciation, right? I think people talk about sort of INR depreciating against USD, but because of the tariffs, depending on how yuan depreciates against USD and the relative depreciation of INR versus yuan will also decide the export competitiveness for Indian chemical industry in general. So I think with both these factors, we continue to, as I said, analyze the situation. But broadly, net to answer your question, 20 to 25% of our product portfolio sort of lands up in US, and that's what will have impact depending on the US trade policies.
On India, which is what it appears, because so far we've not seen anything in the fine print and it may remain like this. So can I say that for this 20% portfolio, where you were competing with China, suddenly you will have an advantage?
Well, I mean, we are in the market right now, right? It's just that I think the tendency to allocate higher volumes to India might sort of happen over the course of next 12 to 18 months, provided this rates of tariff continues.
But if you can also update us on your Capex plans as well, because there the company has been focusing for quite some time now. So going ahead, maybe in the next 2 quarters, how much of capacity can we expect to come in? As well as what I believe is that you have already revised your Capex guidance lower this time. So what made you do that?
So we have not revised guidance for Capex this quarter. I think in the last quarter, we had given updated Capex guidance of roughly 1,300 to 1,500 crores for this year, this financial year, and 1,000 crores for the next financial year. We continue to maintain exactly the same Capex guidance. As far as capacity expansions are concerned, in this quarter, we're happy to inform that we commissioned our nitrotoluene and ethylation chain capacities, which will get ramped up in this quarter and the subsequent quarters. In terms of incremental, I think we're building a new greenfield site at near Jagadia, which will see gradual commissioning over the course of FY26. A pilot plant in that site has already got commissioned in the last quarter. One multi-purpose plant will get commissioned over the course of next 6 to 9 months, and the remaining units will also see gradual commissioning throughout the year of FY26. So the Capex guidance remains intact. I think roughly 1,300 to 1,500 crores this year and 1,000 crores for the next financial year.
So you're so good having you on the show. Thank you so much for your time today.
Thank you for having me.